When most of us start investing, we're basically told by everyone to just, well, get on the commuter train.
Right, yeah. Take your seat and don't touch anything.
Exactly. You buy a passive S&P 500 index fund, you sit down, and you just kind of accept whatever speed the train happens to be going.
I mean, it is the ultimate set it and forget it strategy. Sometimes it crawls, sometimes it speeds up. But, you own a tiny piece of the entire train line. You get the market return. Nothing more, nothing less.
Right. But then you look at the window of that train and you see these sports cars just tearing down the highway, absolutely blowing past you.
Yeah, the ones capturing the real outperformance.
Exactly. So today, welcome to a special masterclass deep dive where we are looking at a huge stack of data. We're talking dense academic research. We've got the actual prospectuses of 3 modern quantitative ETFs, and we're trying to figure out how you can systematically hop into whichever car is accelerating the fastest right now.
Because, if everyone defaults to the safety of a passive S&P 500 fund, you have to ask yourself why on earth you should risk stepping out of it.
Right, and to figure that out, we are pulling from the definitive macro momentum academic research paper from AQR Capital Management. We're also digging deep into the fact sheets for MarketDesk's FMTM, SmartWay's SGRT, and Strategis's SAM.
Plus, we're looking at a really great independent YouTube review by Dr. Jeffrey Miller to scrutinize the math, and checking out real-world sentiment from Reddit investor forums, too.
Okay, let's unpack this, because the whole idea of momentum investing, like buying what is already going up, it feels completely backwards to everything we are taught about buying low and selling high.
It does. It feels incredibly counterintuitive. We are so conditioned to look for bargains, right?
Oh, absolutely. Everyone wants to buy the dip.
Exactly. But momentum investing, this tendency of winning assets to keep winning and losing assets to keep losing, it's actually deeply rooted in market mechanics. The AQR Capital Management research establishes this as a long-standing academic phenomenon.
Wait, how far back does that research actually go?
Well, AQR built a systematic backtest stretching all the way back to 1970.
Wow, okay. Over 50 years.
Yeah, that 50-year sample covers major historical volatility. It includes the extreme interest rate hikes of the Volcker era in the early 1980s.
Right, when Federal Reserve Chair Paul Volcker pushed rates into the double digits to just absolutely crush inflation.
Exactly. It covers that. Oil shocks, multiple recessions, the global financial crisis. And across that entire half-century, they found momentum strategies delivered remarkably consistent performance.
So a half-century of data is pretty hard to argue with, but why does it actually work? If the stock market is supposedly efficient, shouldn't stock prices instantly reflect all the good news the second an earnings report comes out?
See, that's the thing. The AQR paper pinpoints the exact behavioral quirk that makes momentum profitable, which is that human beings gradually underreact to news.
Underreact.
Yeah. When a company announces massive, unexpected earnings or some major geopolitical shift happens, market participants don't instantly reprice the asset perfectly. We hesitate. We anchor to old prices.
So, if a stock is trading at $50 and they announce a revolutionary new product, investors might bump it to $55, but they mentally anchor to that old $50 price tag.
Exactly. They don't want to believe it's suddenly worth $80 overnight.
Right. They think it's too good to be true.
Yeah, they want to wait and see if the news is real. And this gradual, delayed processing of information creates a fundamental trend, like a slope, that successful quantitative managers can actually identify and profit from before the rest of the retail market finally catches up.
I see. So buying the S&P 500 is like earning the entire highway.
Right.
The fast cars, the slow cars, and the broken down ones on the shoulder. But momentum investing is trying to exclusively ride in the vehicles that are actively accelerating.
That's a perfect way to put it. You are paying a manager to actively, constantly swap you into the fastest car on the road.
And the ETF wrapper has totally democratized access to these strategies for normal investors. But not all momentum ETFs are built the same, are they?
No, not at all. Which, well, if we connect this to the bigger picture, if momentum is academically proven, how is it captured in the real world today?
Right. Which brings us to our first specific strategy, pure price momentum. And this is captured by MarketDesk's focused U.S. momentum ETF. The ticker symbol is FMTM, and it carries a 0.45% expense ratio. So how is this fund finding those fast cars?
So FMTM relies entirely on price action and advanced mathematics. It differentiates itself from older legacy passive momentum funds like the massive BlackRock ATUM fund or Fidelity's FDMO by making a few structural tweaks.
Structural tweaks, like what?
The biggest one is the look-back window. FMTM uses a 6-month window to measure a stock's momentum.
Wait, whereas the industry standard has historically been a 12-month window, right?
Exactly.
But in data analysis, having more data is usually the goal. Why would you intentionally shrink your field of vision to just 6 months?
Because a 12-month window can leave you holding on to stale trends. Think about it. If a stock had a massive run 9 months ago, but has been slowly bleeding out ever since.
A 12-month window still thinks it's a winner.
Precisely. So by shrinking it to 6 months, FMTM is capturing much more current, relevant leadership.
Mm-hmm.
And it's not just looking at the total return over those 6 months either. It evaluates the consistency of the trend.
Right. Dr. Jeffrey Miller covered this extensively in his YouTube review. I think you referred to it as residual momentum.
Yeah, residual momentum. FMTM wants to see a smooth, consistent trajectory. Like if stock A goes up 1% every single week for 6 months, and stock B does absolutely nothing for 5 months, and then just spikes 30% one week because of, say, a buyout rumor.
FMTM strongly prefers stock A.
100%.
Yeah.
It filters out those volatile, choppy price spikes because mathematically those are far more prone to suddenly reverse.
Okay, so it finds these smooth trenders, and then it builds a concentrated, equal-weighted portfolio of 30 to 50 large and mid-cap stocks.
Yeah, and that equal weighting is vital here.
Because in a normal S&P 500 index, the massive tech companies completely dominate the weighting.
Exactly. If you equal weight 50 stocks, the 50th stock has the exact same impact on your returns as the number one stock. It forces the fund to actually rely on the momentum factor across the board rather than just riding the coattails of 2 or 3 mega-cap tech giants.
That makes sense.
And perhaps most importantly, FMTM rebalances every single month.
Okay, I have to push back here on behalf of anyone listening who's ever worried about their tax bill. With monthly rebalancing, aren't we just eating up all our potential returns in taxes and trading fees?
It sounds like it, right?
Yeah. I mean, you are churning the portfolio 12 times a year. If I do that on my personal brokerage account, the IRS is going to absolutely crush me on short-term capital gains.
And that is a major reason why high turnover strategies like this used to be strictly limited to hedge funds. But the Market Desk FAQs explain how the modern ETF wrapper actually solves this. They use something called the in-kind creation and redemption mechanism.
Can you break down how that actually works in practice? Because it sounds a bit like magic.
It kind of is. So when an actively managed ETF wants to get rid of a stock that has appreciated in value, it doesn't just click sell for cash on the open market.
Because that would instantly trigger a taxable capital gain.
Exactly. Instead, it essentially swaps a basket of those appreciated shares with large institutional market makers in exchange for ETF shares.
Oh, I see.
Yeah, this in-kind swap allows the fund to flesh out highly appreciated stock without actually realizing the capital gain at the fund level.
Wow. So you get the agility of active monthly rebalancing without the traditional tax drag.
Right, and that monthly rebalance acts as a rapid defense mechanism. If the market suddenly pulls back, FMTM can rotate out of deteriorating trends in a matter of weeks.
Whereas legacy passive funds that only rebalance semi-annually might be stuck holding those falling knives for months. Okay, but wait. Here's where it gets really interesting. FMTM is just looking at the price chart, right? What if a stock's price is going up purely on hype, like a meme stock where the company is essentially bankrupt? Doesn't relying solely on price leave you vulnerable to garbage companies?
It absolutely does, and that vulnerability takes us directly to our second contender, SmartWay's SGRT. That's the Smart Earnings Growth 30 ETF.
Okay, and this one has a slightly higher expense ratio at 0.59%.
Right, but it answers that exact flaw you just mentioned by operating on a completely different philosophy. It uses fundamental momentum.
Meaning SGRT completely ignores the stock price chart.
Completely ignores it. It is hunting for momentum in the underlying business metrics. According to their prospectus, they start with the 850 largest U.S. equities. Then they run a proprietary ranking process to find companies demonstrating top-tier sales growth, successful new product launches, and massive quarter-over-quarter earnings expansion.
Okay, let's explain the causality there. How do specific metrics like new product launches translate into momentum? Because that feels a step removed from the stock price.
SGRT focuses on things like new product launches because of the revenue lag.
The revenue lag.
Yeah, so when a tech company launches a massive new artificial intelligence chip, the market might bump the stock price up 5% today, but it takes 3/4 for the actual sales of that chip to travel through the supply chain and show up on the balance sheet.
Oh, right. It takes time for the cash to actually hit the register.
Exactly. SGRT buys the stock today to ride that inevitable wave of upcoming earnings beats. It narrows that initial list of 850 down to 100, and then ultimately selects a highly concentrated, high-conviction portfolio of exactly 30 stocks.
Just 30 stocks. And when you look at the actual holdings data from FinHub, the results of this purely fundamental screen are incredibly skewed.
Oh, heavily skewed.
Yeah, we are talking top holdings like Lumentum, Western Digital, Micron, Nvidia, and Dell. Over 56% of the entire fund is concentrated purely in the technology sector. So you have to ask, are you really tracking a systematic momentum factor here, or are you just making a massive concentrated bet on big tech?
And that is the defining tension of fundamental momentum. By purely following the earnings and sales growth right now, the algorithm is dragged directly into the semiconductor and AI boom because that is where the fundamental business growth currently lives.
So it's not tech for the sake of tech?
No, it is an unconstrained bet on the absolute fastest growing companies. If the tech sector continues to deliver explosive earnings, SGRT will likely soar.
But if you're holding almost 60% tech, what happens if the entire tech sector crashes?
Then SGRT goes down with the ship.
Right, because you have zero diversification to protect you. So is there a way to capture momentum but zoom out even further to avoid being trapped in one sector's collapse?
Well, what's fascinating here is that there is. Enter the Strategas Macro Momentum ETF, ticker SAM.
Ah, SAM. So how does macro momentum work?
Strategas takes a top-down approach. Instead of looking at an individual company's price action like FMTM or hunting for a specific company's sales growth like SGRT, SAM looks at global policy, broad economic trends, and macro inputs.
Okay, so a much wider lens.
Exactly. The prospectus outlines how they utilize technical indicators like absolute and relative rates of change, moving average crosses, RSI, and MACD.
Okay, let's translate those technicals for a second. MACD, moving average convergence divergence, that's basically looking at the relationship between two different moving averages to spot changes in a trend's strength, right?
Exactly. And a moving average cross is even simpler. If a 50-day moving average crosses above a 200-day moving average, that's a classic signal that short-term momentum is building positively against the long-term trend.
And RSI, the relative strength index, that measures the speed and magnitude of recent price changes to see if an asset is technically overbought or oversold.
Spot on.
So how does a macro ETF actually execute a trade based on those factors? Walk me through a scenario.
Sure. Let's say the RSI shows European industrial stocks are deeply oversold, like they've been beaten down way too far too fast. But suddenly the MACD starts shifting, and the 50-day moving average just crossed the 200-day, indicating a brand new upward trend is forming in that sector. SAM doesn't just buy one specific European company, it buys the entire sector or region to ride that macro tailwind.
Wow, whether it's driven by shifting inflation, monetary policy, or something big like deglobalization.
Exactly.
I love that. So if SGRT is looking at the company's internal resume and FMTM is looking at the stock's current speedometer, SAM is essentially looking at the weather forecast for the entire global economy.
That's a great analogy.
If the wind is blowing toward a specific sector, SAM is adjusting the sails of the portfolio before the rest of the market even checks the weather.
Right. SAM identifies which asset classes or sectors possess the strongest global momentum and just rotates the portfolio accordingly.
Okay, so what does this all mean? We have these three incredibly sophisticated, data-driven funds. They sound fantastic in theory.
They do.
Right. I mean, who wouldn't want to own the fastest moving stocks, the best fundamental earners, or the strongest global macro themes? But as seasoned financial analysts, we need to play devil's advocate for you listening at home. Stepping outside the safety of a passive S&P 500 index fund introduces very real inherent risks that you absolutely must be aware of.
Yeah, we have to talk about the downsides. First, there are the tangible costs. You're paying expense ratios of 0.45% for FMTM or 0.59% for SGRT.
Which doesn't sound like a lot at first glance.
No, but compared to the near zero cost of a basic S&P 500 fund, that is a massive hurdle. Over 10 or 20 years, those higher fees compound and eat directly into your returns.
And we also mentioned the portfolio turnover. These active strategies are constantly buying and selling. I mean, even with the ETF tax efficiencies we discussed earlier, that level of turnover introduces execution risk and internal trading costs.
Yeah, and we also have to highlight that heavy, unconstrained sector concentration we saw with SGRT. If you sacrifice diversification for concentration, a 30-stock portfolio heavily weighted in one sector, is going to feel a world of pain that a diversified 500 stock index simply won't.
Which brings us to the absolute elephant in the room, the momentum crash.
Oh, yeah.
Dr. Jeffrey Miller covered this heavily in his YouTube review, and it is frequently cited in the AQR academic research, too. Momentum looks brilliant on the way up, but what happens when the market suddenly changes direction?
That is the historical Achilles heel of this entire philosophy. A momentum crash happens during sudden market regime shifts, or fast reversals.
Like what?
Think about the bursting of the tech bubble in 2000, the 2008 financial crisis, or the massive tech sell-off we saw in 2022. When market leadership abruptly flips, say, growth stocks suddenly crash and boring value stocks start rallying, a momentum strategy is usually fully invested in yesterday's winners.
Because the algorithm is looking at the last 6 months of data. It doesn't know the future.
Exactly. The algorithms take time to process the new data, rebalance, and find the new trend. And during that lag, the drawdowns can be deep and severe. Dr. Miller explicitly warns in his review that these fast crashes are not anomalous disaster scenarios. They are normal operating conditions for any momentum strategy.
You just have to be prepared to stomach them.
You really do.
Which brings me to the track record scrutiny. We saw this pop up in the Reddit investor forums we pulled. One user noted that they liked FMTM because it drew down less than the S&P 500 during a recent correction. Another user simply posted, SPMO is the GOAT, which is referring to an older passive momentum fund.
Right, SPMO.
But the overarching concern from the retail crowd, which Dr. Miller echoed, is the total lack of history. Both FMTM and SGRT launched very recently in 2025.
Yeah, they are very new to the public market.
I mean, they have incredible short-term returns. SGRT boasts its massive cumulative returns since inception, and FMTM was up over 57% in its first 13 months, outperforming the S&P 500 easily. But their proprietary black box algorithms lack the decades-long, independently audited public track records that you actually need to separate true skill from pure luck. I mean, did they build a better mousetrap, or did they just happen to launch during a massive historic bull market for tech and momentum stocks?
Right, and this raises an important question, because it is impossible to know for sure without 20 years of live, real-world data. So knowing these risks, should an investor ever go all in on these highly concentrated active momentum strategies?
I'm guessing no.
The conclusion drawn across all our sources, from the academic literature to the prospectuses to the independent reviewers, is a resounding no.
So please do not sell your house to put your entire life savings into a 30-stock earnings momentum ETF.
Definitely not. These tools are best used as satellite positions, or as part of a barbell strategy.
How does that look in practice?
Well, you keep your broad market S&P 500 fund as your massive stable core holding the foundation of your house. Then you allocate a smaller satellite percentage of your portfolio to these active momentum ETFs on the periphery. You're attempting to capture that targeted outperformance without risking your entire retirement on a sudden momentum crash.
Right. Let's synthesize this. We've seen today that the ETF landscape is evolving far past just buying the whole market. You now have the option to trade the passive, stale, quarterly rebalancing of legacy funds for agile, data-driven exposure. You can target the purest, smoothest price trends with FMTM.
You can hunt for aggressive, tangible business growth with SGRT.
Or you can ride the winds of global policy and macroeconomics with SAM. The trade-off is clear, though. You have to accept higher fees, higher portfolio turnover, heavy sector concentration, and the very real historical threat of sudden, brutal momentum crashes.
Yeah, you're paying for agility, but agility comes with sharp turns. But before we go, I actually want to leave you with a final thought to mull over.
Okay, let's hear it.
The foundation of this entire deep dive, the AQR research, it showed that momentum works primarily because human beings naturally underreact to news, right? It creates those gradual, exploitable trends due to our behavioral hesitation and our anchoring bias.
Right, we don't process information perfectly, which leaves meat on the bone for the algorithm.
Exactly.
Yeah.
But as these highly concentrated quantitative ETFs grow, and as artificial intelligence begins to instantly digest, analyze, and price in global financial data in milliseconds, will that human underreaction eventually disappear entirely?
Oh, wow.
And if it does, what happens to the market when all of these mathematically identical momentum algorithms try to hit the exit door on the exact same 30 tech stocks at the exact same millisecond?
Man, talk about a potential traffic jam on that highway we talked about earlier. Suddenly, everyone is trying to jump out of the exact same speeding sports car at 100 miles an hour.
That's a scary thought.
It really is. Remember, you should always do your own research and read the actual fund prospectuses yourself before putting a dime of your hard-earned money to work. Thank you so much for joining us on this deep dive into the fast lane of momentum investing. We'll see you next time.